Hello, I'm Chip Stites, and this is The Laughing Retirement. Today, I want to give you a portfolio update. And we do this on a regular basis. We don't cover anything up. We have a bad day, we have a bad day. We have a good day, we have a good day. I have absolutely nothing to hide here. I'm not trying to make something, I'm not trying to make a silk purse out of a sow's ear, if you will. I'm trying to show you what works. So let's start right now. Updating the pie portfolio results in a time of change. And we are looking at a time of change. Now, this is my portfolio, and this is what it looks like. I have two portfolios, what I call the growth and offset portfolio. And then I have a dividend portfolio. Growth and offsets make about 24% of the portfolio, and dividends make about 76% of the portfolio. Now, year to date, now, this is late in August. Year to date, the growth and offset portfolio was up 14%. The S&P was up 10. The dividend portfolio was up 2. Over 12 months, the growth and offset portfolio was up 16. The dividend portfolio was up 3, and the S&P was up 17. Now you got to remember, I'm taking 65% of market risk, or if you will, 35% less risk than the S&P 500. So I would expect 35% less return than the S&P 500. Now, in 2024, since 2024, the growth and offset portfolio has made 8%. The dividend portfolio has made 13.97%. The Dow's made 25. Since 2020, my growth and offset portfolio is minus 7.63%. I made a couple of mistakes, and that affected the portfolio to 2021. 22, we had a very good year. The dividend portfolio over that period of time is up 11% on average. Now, the S&P 500 is up 18.57. And if I were to take 18.57 and multiply it by 0.65, I get 1207. So I'm pretty close, within 60 basis points or 0.6% of hitting that mark right on the nose with my dividend portfolio. Now let's put these two portfolios together and let's take a look at what we got. Year to date, we're at 8.79%, and the S&P is at 10.55. That's better than 65% of the S&P 500. 12 months, I'm at 8.82. The S&P is at 17.65. That is less than 65% of the market return. Since 2024, I'm at 12.47, and the S&P 500 is at 25.62. Since 2020, I'm at 6.93, and the S&P 500 is at 18.57. Now, you might say to yourself, geez, Chip, the S&P 500, if I just had the S&P 500, I'd have had 18.57%. I'd say that's right. And your dividends would have been at about 1.5%, give or take 1.38, it changes. And my dividends are at 5.75 almost. So what does an investor need to succeed? Why am I sitting here telling you this? Since 2020, I've gotten 7%, and the market's done 18. Well, see, in 2022, when the average person lost 30%, I gained 3%. In other words, over this time, as you can see, over this time, portfolio hasn't done too bad. I don't worry about it going up and down at all. I don't have that problem. And I can count on a return of about 5.75% from my portfolio every year. Not only that, but I can count on them paying less taxes on that than you will if you're taking money out of an IRA. So I'm gaining in less risk, I'm gaining in taxation, and I'm saving a lot of fees at the same time. I don't have any fees, and you can do that yourself. Now, what does an investor need to succeed? Now, this comes from my mentor, WinCaps, who I owe a lot to. His formula was taxes plus inflation plus the cost of investing plus 1 to 3%. There you go. Taxes plus inflation plus the cost of investing plus 1 to 3%. That's all you need to do. You don't need 15%. You don't need 10%. You just need to beat taxes plus inflation plus the cost of investing. And that's the hard part. In that, what can you control? You can only control taxes plus inflation. You can only control the cost of investing. It's the only thing you can control. You can control your risk, but in that formula, you can only control the cost of investing. Market's going to do what it's going to do. Inflation's going to do what it's going to do. You don't have any control of that. Taxes are going to be what Congress says they're going to be. You don't have any control of that. So I want to control the things that I can control. Now, the proof is in the pudding. My weighted average return over that period of time was 6.93%. Taxes are 20%, inflation is 3.1%, and my costs are 0.05%. This is what I got. Taxes were 5. After taxes, I'm earning 5.5%. My cost, inflation, can't do anything about that. I'm left with 2.45%. If I subtract my cost of investing, 0.05, I'm left with 2.4%. So I beat my expenses and my cost, the inflation and the taxes, by 2.4%, taking less risk than the market. Now, Dr. Jeremy Siegel in his book says that over time, value investing will equal or beat growth investing with less risk. And risk and expenses are the two things you can control every time. And that's something we're going to talk about in an upcoming masterclass on September 21st. That's a Sunday at 11 a.m. on Zoom. Now, we've got a video coming out about the masterclass, and I want you to sign up for it. You can talk to me. You can argue with me all you want. You can tell me I'm an idiot. That's okay. Now, my pudding tastes pretty good. My results are pretty nice. I bested my expenses, taxes, inflation, and costs with less market risk. My return is more consistent, less volatile than the market. My lows are much higher than the market lows, and my income is much higher than the S&P 500, about 3 times. I paid less taxes at around 15% that came out, and my average tax bracket's around 24. There you have it. Now, let's look at one day. I'm going to just pick on one day. Everybody says, oh, no, it's years, you want lots of time. Yeah, I can show you this over time, too. I can show you how this works over time. One day, September 2nd, the Dow was down 0.55%. It was down 0.5%. The S&P was down almost 0.7%. The Russell was down 0.6%, a little bit more than 0.5%. And the NASDAQ was down 0.82%. The NASDAQ takes more risk than all of them. This is natural. My portfolio was off 0.39%. And I take 65% of market risk. If I take my 0.39% and I divide it by what the S&P did, minus 0.69, on that day, I was taking 57% of market risk on that day. Warren Buffett has a rule: don't lose money. What I've learned over 47 years in this business is that it's much harder to earn money back than it was to earn the money to begin with. And I can give you example after example of person after 2008 that said, I'm too afraid to get in the market. I can't get in the market. I didn't get in the market. My average client lost about 11.7% and had their money back in 18 months. That consistency, lack of risk, that is what you're looking for. Now, what else do you need in time of change? Well, you need to have some gold. That is the one thing that I can think of that has historical value. Diamonds also have consistent historical value. Not only that, but diamonds travel all around the world. You can put diamonds in your pocket and walk anywhere and nobody will say anything. You put more than $10,000 in your pocket, they'll stop you and take it from you, confiscate you, and ask you what you're doing. Cash doesn't move around very well anymore. Diamonds do. Digital coins, I'm not a fan because they're a fiat currency. They're a currency that has no inherent value, other than people saying it has an inherent value, unlike gold. Now, I own one digital asset, and I'm watching it very carefully to see what it does over time, to make sure that this makes sense. Now, I have a masterclass coming up on September 21st at 11 a.m. That's a Sunday, 11 a.m. September 21st. The masterclass will cover 4 kinds of stocks, and we'll give you the list. We'll give you some list of those stocks too, that can increase your income, lower your taxes, reduce your risks, and help you grow your portfolio. It's something that gives you consistency over time. And I want to thank you for your time because I know how valuable it is. One of the things that you will find is that if you don't understand something while you're working with me, and you ask a question on it, I'll sit there and answer that question until you get it. Because one of the things when I was working, I couldn't stand was somebody walking out after a meeting with me saying, I didn't understand a word that guy said. So I would go back and forth over things until people say, yeah, I got it. Because you should understand what your money is doing. Now, one of the values of this class coming up, and I'm going to go back to this. I'm going to go back to this slide. One of the values of this class is that I will answer your questions. I will stop. I will show you how simple it is. I know most of the time people believe, well, I can't do that. But I can show you how you can do it. And I have people that do this way and can save you 60% of your expenses along the way. And I can show you that too. So I hope that you will join us September 21st, Sunday, 11 a.m. on Zoom, and that you will sign up for that class so that we can sit and talk about it. I'm Chip Stites. This is The Laughing Retirement, and we'll see you soon.